Good morning. What do the Fed rate cuts mean for CRE lending in the remainder of fourth quarter 2025? Well, the Federal Reserve's decisions on interest rates are among the most important drivers of commercial real estate or CRE lending. In 2025, as the Fed pivots toward rate cuts, after several years of higher for longer monetary policy, commercial real estate investors and developers are asking, well, what does this mean for my financing opportunities, loan costs, and deal making? Well, as a mortgage broker, with access to hundreds of lending partners, I help clients navigate the impact of Fed policy shifts on their borrowing power. And here's really the key tidbits of what you need to know. So, why do Fed rate cuts matter for CRE lending? Well, when the Federal Reserve lowers the federal funds rate, borrowing costs across the economy typically decline. Now, for CRE borrowers, this will mean lower interest rates. Not that the Fed actually lowers the interest rate that banks lend, but they can get their money cheaper, so they pass it on to us. Commercial mortgage loans, bridge loans, construction financing may carry reduced rates, improving cash flow and making more deals pencil. There's cap rate compression. So lower cap rates often drive higher property values since investors accept lower yields when financing becomes cheaper. It opens up the door for refinancing opportunities. So owners of existing CRE loans can lock into better refinance terms, which basically unlocks more capital for new acquisitions. So it's a double edged sword. Liquidity boost. More lenders re enter the market as risk adjusted returns improve when rates fall and credit loosens, usually as a result. We need to get back there. And here's our CRE lending for the remainder of outlook of 2025. Several key shifts are already shaping the CRE lending market in 2025. There's a multifamily refinancing wave with over 500 billions in CRE loans maturing by 2026. So many borrowers will seek refinances under more favorable rates, and those that were stuck can now proceed. Construction and development financing. Lower rates may revive stalled projects, particularly in markets like Houston, Dallas, and Austin, where demand for mixed use, multifamily, and industrial remains strong. Investors can leverage their returns. So, as debt service coverage ratios, DSCR, becomes easier to meet, investors can take on more leverage without stretching cash flow. It's good for everybody, is the concept. So SBA and agency lending expansion. So SBA 504, 7A, and agency-backed multifamily loans are expected to see higher demand as rate cuts make long-term fixed rate options more attractive. Now, here are the risks to watch because you can't have all good news. It's got to be some bad news. While rate cuts create opportunities, investors should stay cautious of a cap rate mismatch. So property values may rise faster than actual rent and income growth. So you got to adjust your prices. Bank caution. So bank caution. Regional banks are still balancing balance sheet risks after the 23-24 CRE stress period. So once they loosen up there, lending can increase from there. So inflation uncertainty. If inflation rebounds, the Fed could pause or reverse rate cuts. So that's something we have to look out for because the economy is moving at a good clip. Final takeaways for CRE investors, developers, and business owners. Fed rate cuts in 2025 are a green light for smarter borrowing and refinancing strategies. But lenders will remain selective, so making it critical to work with an experienced mortgage broker who can position your deal with the right capital source. So here at Medallion Funds, we connect you with the best fit lenders for your commercial real estate needs. So whether you're refinancing, developing, or acquiring new properties, we've got the solutions. That's it for the day. Have a good one.